What does JPMorgan Chase chief economist Anthony Chan think of all of this? What do you, Anthony? I mean, it is an interesting development. Last 7 recessions, this phenomenon has happened. Of course, we've had this phenomenon in the past, but not always producing a recession. But what do you think of it?
Well, Neil, it's always nerve-wracking when you get an inversion of that yield curve. I actually sort of developed a new way on how to forecast recessions using the inverted yield curve and also using the index of leading economic indicators. Both of them tell you when a recession is coming. But what I've done is to combine both of those indicators and as far back as the data on 2-year treasuries and 10-year treasuries. And I find a 100% forecasting track record in terms of forecasting a recession on average about 11 months before a recession starts. And right now, the index of leading economic indicators, of course, has not had those 3 monthly declines that typically signal a recession. But yes, the inversion of the yield curve is getting tighter. And right now, as we speak, Neil, the yield curve has a 35 basis point spread right now with that 10-year hovering at 288. So it's getting awfully close. But guess what? If the kids were in the minivan, we would say we're on our way to the destination, but we're not there yet.
That's a good analogy. So you're saying that we would be presumably 11 months or so away, given this, from a recession or at least a slowdown.
Yes, but we don't have both of those indicators telling us that a recession is coming. And by the way...
And you need both, right?
You need both to get that 100% forecasting tracking record. Okay. But in any event, when you do get an inversion of the yield curve by itself without looking at the other indicator, it typically means a recession comes about 18.3 months into the future. And since we don't have it yet, I'm not as worried, but if you really want to be a stickler, Neil, if you look at the futures curve, looking at the swaps curve, it's already pretty flat, suggesting that things are getting a little bit dicey. But I'd rather focus on the traditional measure of that inversion of the yield curve, and that hasn't happened yet.
All right, let's talk about more immediate events like this trade war has seemed to escalate and has been, walloping the Dow and a lot of financial markets now, technology, even small cap stocks. What do you make of it? How real a threat is this to what has been, a pretty giving market?
I think it is a little concerning. I don't think we're at a critical juncture yet. But when I hear the chairman of the Federal Reserve saying that there's already some anecdotal evidence that is starting to influence capital expenditures and certainly job hiring. This is still the soft data, which everybody likes to look at, but realizing that soft data impacts the overall economy, which a much longer lag than some of the harder data that obviously has a more instantaneous impact. So if this anecdotal data really spreads out, and so far it's the Federal Reserve telling us, so far it's the flash purchasing manager survey showing that there's a little nervousness out there among manufacturers. But if this were to spread out a little bit, then yes, this could be sowing the seeds for a potential slowdown and some real serious issues moving forward. So I think we're still in the early innings of that issue. And by the way, we can't rule out the fact that we're still away from early July when that next batch of tariffs are going to be imposed. Suppose we formulate a truce between now and then all these things we're worried about, somewhat premature in nature.
Yeah, it could happen. Anthony Chan, thank you very, very much. JPMorgan, chief economist, thank you.